Welcome to Orange US Stock Research. Today, we are diving deep into OSCR Health, ticker symbol OSCR, one of the most fascinating and talked about stocks in the healthcare technology space right now. Founded in 2012 in New York City, OSCR Health set out on an ambitious mission to completely disrupt the traditional health insurance industry with a technology-first, consumer-centric approach. Since its founding, the company has grown into a major player in the Affordable Care Act individual health insurance market, now serving over 3.4 million members as of early 2026. With former Aetna CEO Mark Bertolini at the helm since 2023, the company is undergoing a massive strategic transformation. The big question on every investor's mind is, can this insurtech pioneer finally achieve sustained profitability in 2026 after a very challenging 2025? In this comprehensive analysis, we will evaluate OSCR Health across multiple important dimensions, including its business model, competitive moat, financial health, growth potential, risk factors, and current valuation. We will conclude with our proprietary 100-point scoring system and our final investment verdict. So let's get started. Let's begin with the company overview and business model. OSCR Health operates primarily in the Affordable Care Act, or ACA, individual and family health insurance market. This is a market that has been growing rapidly, now exceeding 21 million enrollees nationwide, and some industry projections suggest it could eventually reach 120 million lives. Unlike legacy insurers relying on outdated systems built decades ago, OSCR built a full-stack proprietary technology platform from the ground up. This allows them to offer a highly intuitive digital experience, including 24/7 virtual care access, AI-driven care navigation, and personalized concierge support for every member. Their core business model revolves around capturing market share in the growing individual insurance space. Growth is driven by several important secular trends, including the rise of the gig economy, the growing freelance workforce, and the expansion of ICHRA, where employers provide stipends for workers to purchase their own health plans on the individual market. Additionally, OSCR monetizes its technology through its B2B platform called Plus OSCR, which enables other regional health plans to utilize OSCR's modern infrastructure to improve efficiency and profitability. The company is led by CEO Mark Bertolini, who previously served as CEO of Aetna. His deep industry experience has been instrumental in reshaping OSCR's strategic direction. Now let's examine OSCR's competitive moat in detail. The story clearly centers around technology and superior customer experience. In an industry notoriously hated by consumers, OSCR boasts a Net Promoter Score of approximately 60, which is exceptionally high and far above what traditional insurance peers typically achieve. This means OSCR's members genuinely like their insurance experience, which is almost unheard of in this industry. Their AI-driven platform streamlines administrative tasks significantly. According to the company, their artificial intelligence tools have saved the equivalent of over 200 service representatives worth of work. This creates a structural cost advantage visible in their declining SG&A expense ratio, which improved from 19.1% in 2024 to 17.5% in 2025. Furthermore, their Plus OSCR B2B platform creates meaningful switching costs for partner insurers. Once a regional health plan integrates with OSCR's technology stack, migrating away becomes costly and disruptive. However, we must be honest about the limitations. Giant incumbents like United Health Group, Elevance Health, and CVS Aetna have massive scale advantages and deep pockets. They can invest billions in technology if they choose to. OSCR must therefore constantly innovate to maintain its technological edge. It is also worth noting that OSCR has built a significant data advantage over time. With over 3 million members generating real-time health data, OSCR can train its AI models more effectively than smaller competitors, creating a self-reinforcing flywheel where better data leads to better predictions, better care coordination, and ultimately lower costs. Turning to the financials, 2025 was a year of decidedly mixed results for OSCR Health. On the positive side, total revenue reached $11.7 billion, representing a 27% increase year-over-year from $9.2 billion in 2024. This growth was primarily driven by surging membership. However, profitability remains a major challenge. The medical loss ratio, or MLR, spiked to 87.4% for the full year, up significantly from 81.7% in 2024. This increase was driven by higher market morbidity and elevated medical utilization. As a result, OSCR reported a net loss of $443 million, a sharp reversal from the $25 million profit in 2024. Adjusted EBITDA also swung to a loss of $280 million compared to positive $199 million the prior year. On a brighter note, their SG&A expense ratio improved to 17.5% from 19.1%, demonstrating that technology-driven operational efficiency continues to deliver tangible cost savings even during a challenging year. Looking at the balance sheet, OSCR ended 2025 with approximately $2.4 billion in cash and investments, providing a solid liquidity cushion. The company has no long-term debt, which is a meaningful advantage as it navigates the path to sustained profitability. Now let's examine the balance sheet and capital position. OSCR maintains solid liquidity despite operating losses. As of December 2025, the company held $2.77 billion in cash and equivalents, a significant increase from $1.53 billion at year-end 2024. They also held $1.22 billion in short-term investments, bringing total liquid assets to nearly $4 billion. Total assets stood at $6.33 billion against total liabilities of $5.34 billion. Stockholders' equity was approximately $981 million, down slightly from $1.02 billion at year-end 2024. The company carries a substantial accumulated deficit of $3.3 billion from years of aggressive expansion, secured a new $475 million revolving credit facility from top-tier banks. CFO Scott Blackley described this as an opportunistic step to strengthen the balance sheet, providing additional flexibility to fuel growth and meet statutory capital requirements. Let's now turn to growth potential and the 2026 outlook, arguably the most exciting part of this analysis. OSCR achieved a record membership of approximately 3.4 million members as of February 2026, roughly doubling its base in just a couple of years. This demonstrates strong consumer demand for OSCR's differentiated product. Management's guidance for 2026 represents a potential inflection point. Total revenue between $18.7 billion and $19 billion, approximately 60% growth year-over-year. CEO Mark Bertolini has declared 2026 as the year OSCR returns to sustained profitability, guiding for earnings from operations between $250 million and $450 million. They expect the medical loss ratio to normalize to the 82 to 83% range, while reducing the SG&A ratio to approximately 16%. Looking beyond 2026, the addressable market is enormous. The total individual health insurance market could eventually hold around 120 million lives. OSCR currently serves just a fraction of that opportunity. The company plans to double its geographic footprint by 2027, adding 150 new metro areas. Despite the optimistic outlook, OSCR faces several significant risks that investors must carefully consider. The most pressing is regulatory and political uncertainty. OSCR's business is highly dependent on the ACA individual market. Any changes to ACA subsidies, particularly the potential expiration of enhanced premium tax credits, could severely impact enrollment and affordability. While outright ACA repeal is unlikely, even modest subsidy reductions could meaningfully slow growth. The second major risk is medical cost inflation. The alarming 95.4% medical loss ratio in Q4 2025 vividly illustrates how vulnerable margins are to unexpected claims spikes. Risk adjustment transfers reached 18.5% of direct premiums in 2025, up nearly 4 percentage points, and OSCR expects approximately 20% in 2026. Third, competitive pressure from legacy giants remains intense. United Health, Elevance, and Centene have entrenched provider networks and massive scale. As the ACA market grows more profitable, these incumbents are expanding exchange offerings aggressively. Finally, execution risk is elevated. Balancing rapid growth while expanding margins is extremely difficult. Lastly, capital risk deserves mention. While OSCR currently holds over $2 billion in cash, continued losses could erode this buffer. If the 2026 profitability target is missed, the company may need to raise additional capital, which would be dilutive to existing shareholders. From a valuation perspective, Oscar presents an interesting and somewhat polarizing case. The stock trades at a significant discount due to its lack of current profitability. With a market cap of around $3.9 billion and projected 2026 revenue of nearly $19 billion, the forward price-to-sales ratio is roughly 0.21. The trailing price-to-sales is approximately 0.35. Price-to-book sits at about 4 times. Because the company generates net losses, a traditional P/E ratio is not applicable. Wall Street analysts maintain an average price target of $16 to $17, suggesting 20 to 28% upside from current levels around $13. The high target is $23, the low is $10, $27, over 100% upside. However, this requires flawless execution. The key question is whether the current depressed valuation adequately compensates for execution and regulatory risks. Now let's move to our final scoring across 5 key dimensions. Each is scored out of 10, and the total is multiplied by 2 for a maximum of 100. For business fundamentals and competitive moat, we give Oscar an 8 out of 10. Their proprietary technology platform and exceptional customer experience are truly differentiated. The Net Promoter Score of 60 and plus Oscar B2B platform provide meaningful competitive advantages. For financial health, Oscar scores a 5 out of 10. While liquidity is strong with nearly $3 billion in cash, the massive $443 million net loss in 2025 and elevated medical loss ratio are genuinely concerning. The accumulated deficit of $3.3 billion also weighs on this score. For growth potential, Oscar earns an impressive 9 out of 10. 0.4 million members and projected $19 billion revenue guidance for 2026 is phenomenal growth. The addressable market opportunity remains enormous. For risk profile, we rate Oscar a 4 out of 10. This is the weakest dimension. Regulatory uncertainty, medical cost volatility, and intense competition present significant headwinds. Finally, for valuation, Oscar gets an 8 out of 10. The forward price-to-sales of 0.21 is highly attractive if profitability is achieved. Adding up, 8 plus 5 plus 9 plus 4 plus 8 equals 34, multiplied by 2 gives us 68 out of 100. So what is our final verdict on Oscar Health? Our overall view is a cautious buy for risk-tolerant investors or a strong watchlist candidate for conservative portfolios. Let me walk you through the 3 scenarios. In the bull case, Oscar executes on 2026 profitability guidance, membership grows, the technology moat widens, and the price-to-sales ratio re-rates to 0.5 or higher, implying a $30 stock price, over 100% upside. The MLR normalizes to around 83%. And the stock trades toward the analyst target of $16 to $17. In the bear case, ACA subsidies expire, medical costs stay elevated, profitability is delayed again, and the stock drops to $8 to $10. The turnaround story led by Mark Bertolini is compelling, and the 2026 guidance suggests a massive inflection point may be near. However, the recent spike in medical costs proves the path to profitability won't be perfectly smooth. If you believe in the long-term shift toward consumer-driven, technology-enabled healthcare, OSCR presents an asymmetric risk-reward profile at current valuations. Thank you for watching Orange US Stock Research. This video represents personal opinions and analysis only, intended for informational and educational purposes. It does not constitute any investment advice, recommendation, or offer. See you in the next video.